bring in Tim Speiss, Director of Personal Wealth Advisory Division at Eisner LLP, joining us live out of the NASDAQ market site over in New York. Tim, good to see you, and good evening. You manage money. You run it for C-suite executives, Fortune 100 companies, high net worth individuals, families, sports team owners as well, I understand. What did you do with their money way back in March of '09?
Well, actually, many of our clients stayed the course and remained in equities. There was some paring back. There was some flight to high-quality fixed-income bond positions. But for the most part, our clients, being long-term investors, did not make significant changes to their portfolios.
All right. So net, are they still up nicely by now, or?
Well, they are. I mean, it's I would say not still down, but I would say they remember they stayed in equity and long positions, so they were able to enjoy the upticks in the bull. So they were very pleased about that. But if you look at some of the highs, matter of fact, today is also the 10th anniversary of the tech bubble burst here in the United States. That was in March of 2000. So again, our clients are very sophisticated. They know cycles, but they're long-term investors, and they do recognize that valuations will recover, although we do still have some clients that have not fully recovered from the valuation losses of 08 and 09.
Tim, you're saying they're sophisticated investors but long-term investors. So does that mean they're trading this short-term volatility on the markets?
No. Many of our clients have concentrated positions. Others are diversified. They're in high-quality long positions. We also have many clients that are invested long in hedge funds and private equity, diversified funds. So they're fairly well balanced, attendant to their risk tolerance. So they are not trying to effectuate day-to-day volatility capture on the upside. They really are not looking at it in that way. They're using strategic long-term allocation models, and they truly want to understand risk in a long-term environment.
All right, they're in for the long haul. Tim, we'll get back to you for a lot more in just a bit. Tim Speiss from Eisner LLP over at the NASDAQ market site.
Last week, Joseph Stiglitz, former head economist at the World Bank and a Nobel Prize winner, created a lot of headlines when he was quoted as saying that the Federal Reserve is so fraught with conflicts that it's corrupt. Speaking to CNBC's Maria Bartiromo overnight, Mr. Stiglitz clarified his comment.
Well, what I was trying to bring out was the fact that the regional reserve banks, the New York Federal Reserve Bank, has a key role in regulation and in the last crisis in bailing out the banks. But the heads of these organizations are chosen by a committee which is dominated by the big banks that are being bailed out. So you have the people bailing out appointed by the people who they bail out. It smells bad, it looks bad, it undermines confidence in our system of government.
Well, let's get back to Tim Speiss, Director of Personal Wealth Advisory Division at Eisner LLP, and get your thoughts on this, Tim. Do you think the Fed is compromised, and does that inhibit its ability to regulate banks?
Well, first, we can talk about the United States specifically, but I advocate the view of the International Monetary Fund that recently has said that on a global level, so these are global banks, not only in the United States, but Asia, certainly Europe. And what really they should be doing is combining regulatory policy and monetary policy. And what I mean by that is, for instance, if liquidity is wanting to be put into the global banking system and economy, then capital ratio should be lowered, as an example. Further, if you would see housing prices start to go up or excess credit, what should then be occurring is that loan-to-value ratio should be going up. So in other words, it's not just the large U.S. banks that are assertedly to have control over policy. It's really a global issue, the global banks, the global institutions, certainly countries as well. And the end game is marrying regulatory and monetary policy. It's not just about interest rates, but it's about controlling ratios to both promote liquidity or, if there's excess credit, actually taking liquidity out of the system.
That's certainly an interesting comment, Tim, which gets us to a real-life example. The Greek Prime Minister has been talking overnight about these exotic instruments, essentially speculators betting against Greece. Based on the theory you're just telling us, how would this work in a situation with Greece?
Well, I think in Greece's case, many of us are still trying to understand what Greece's balance sheet really purports, but it would be a classic example whereby countries or financial institutions that would have been making loans to Greece would have looked at Greece's borrowing capacity, their asset to debt levels. They would have been using these International Monetary Fund type regulatory and monetary policy precepts. And keep in mind, everything I'm citing is on a go-forward basis. I'm not stating that. I'm not trying to say what if it was applied on a look back. It's really prospective, and I happen to believe that it makes a lot of sense in the context of determining countries, much like individuals, their credit worthiness, and if there should be restructuring before additional loans would be made to a particular country in this case.
Tim, it's almost inevitable, though, isn't it, that the big hand of government will grow in terms of the regulatory landscape because they've been so instrumental in bailing out so many of these institutions. But where do you strike the balance, or more specifically, how far away are we from striking a balance?
Well, that's an excellent point. Governments across the world have been the lenders and the regulators of last resort over the past 2 years. And what needs to occur is that in the example I'm providing, perhaps it would be financial ratios, leverage ratios, lending ratios, they need to be incepted by these financial institutions. That is the only way that they will become financially viable again, that allows the governments not to have to be continued in the position of supporting their balance sheets. We're after independence here, financial independence, and that will only occur as the deleveraging continues and governments start to be able to pull money out of the lending, banking, financial institution systems.
God, it's certainly been great to hear from you today. Thank you so much. Tim Speiss of Eisner LLP.